Horizon Investments. Zachary, thanks very much. I think I'm over my sneezing fit now. Really appreciate your joining us. What do you think the big theme in 2025 is going to be for equity investors?
I think we had a really good idea of what the theme was, before last week started. And from our perspective, that was looking for continued resilience out of corporate America, earnings growth, and also the tailwind from deregulation and some reform, on the tax rate side of things. All those were set to be really positive developments for earnings and for markets in 2025. And, over this last week, some of that is called into doubt. So I do think we're going to have a bumpy couple of weeks, especially given the liquidity environment over the holiday period.
Do you think the market looks overvalued? I know that's a massive generalization. Companies differ so radically, but do you get a feeling that stocks are inflated right now?
I think there's some pockets of excess for sure, but by and large, as we look at the market as a whole, and even in most of the the kind of the top names, the Mag 7, so to speak, that have been driving returns, those valuations look pretty fair to us, given the dynamics of their underlying business, how asset light they are, and how they've been able to grow revenue and earnings almost no matter what happens in the economy. Stocks like that are companies that investors should want to hold, and they will command a premium valuation because of it. So, we're not thinking that right now valuations are a major headwind to markets. Some of that too is dependent on interest rates and what the Fed does. And last week's development were less positive than we would have hoped. For that Santa rally into the end of the year.
And we've seen evidence of Republicans fighting among themselves over the budget impasse, for example. So the policy changes under Mr. Trump and his colleagues, they may not come as quickly, presumably, as the optimists hope.
Yeah, I think that's right. Last week certainly was about a little bit of what the Fed said and shifting focus to inflation, potentially playing politics with monetary policy in 2025. Markets don't really like that in general, and that's a confusing development. But, the turmoil that we saw in D.C., really an own goal situation amongst Republicans, avoided the shutdown over the weekend just barely. But, that calls into question, the viability of the policy prescriptions that the incoming Trump administration is talking about, especially on the fiscal side of things. If House Republicans are going to hold up things that may expand the deficit, and certainly with deficits where they are, we can understand that. But that is something that the market wasn't really discounting, and had to discount very quickly at a not great time of year last week.
Do you get the feeling, we've heard repeatedly in recent months, that the world has been putting money into the U.S. market, partly because the U.S. economy looks good by comparison with a lot of economies around the world. Is there just too much optimism about America right now?
We don't think so. There have been a couple of reasons money's been flowing into the U.S. One, interest rate differentials, the growth dynamics in the U.S. versus the rest of the world are certainly a major contributor to that. But also, just deeper and more liquid capital markets. It's where the earnings growth is occurring. And investors are going to reward that with their dollars and their euros and their, yen and everything else. And so, I do think that's a kind of interesting dynamic that's been going on. The one bit of caution we have, and I'll say we're not positioning portfolios like this right now, but if I go back to this time in 2016, the overwhelming consensus was that U.S. equities were going to outperform the rest of the world equities, and that was just not the case at all in 2017. The rest of the world outperformed, developed markets outperformed U.S. markets, and emerging markets were actually one of the best big broad contributors across the global equity landscape. We're not calling that. We're not positioning that way as of right now. But I think certainly as we look forward to 2025, it does pay to have an open mind and watch the developments in D.C. Around monetary policy and around the dynamics of the U.S. economy. Because as you said, the U.S. has been the hot place for not just this year, but for the last couple of years.
It doesn't surprise you stocks did so well with so much violence on the geopolitical scene, the Middle East, Ukraine?
I think a lot of those types of very difficult to handicap events, unless they have a direct economic impact, and certainly the beginning of the Russia-Ukraine war, for example, did around gas prices in Europe, and you saw that reflected in asset prices, quite quickly for European equities and the euro. But for more nebulous types of simmering events, it's harder to directly handicap those, and so they don't tend to get fully incorporated into asset prices. I mean, one of the things though that to mention in terms of what's been going on, not just geopolitically, but politically, core Europe, France and Germany are not having a great time in terms of their politics. The attempted coup in South Korea, you can kind of keep naming them. And so, in a backdrop of the world where the dollar has been the safest place to be and U.S. assets have been the best place to be by far. As risk increase around the rest of the world, we do think that increases the attractiveness of the U.S. market.
Thank you very much indeed for joining us, Zachary, and have a wonderful holiday.
Thank you. You as well.
Zachary Hill.